Eric Mwathe. In this educational video, we're going to be talking about the moving averages as far as the weekly charts are concerned. Now, this is a very simple method if you want to find out whether your markets are bearish or whether they are bullish, or at least which direction you think prices might be moving. Now, I know it's a very simple idea, but actually sometimes it does help crystallize whether you should be short or whether you should be long a stock market. And sometimes it's not the easiest thing, and of course I'm going to say this again, it's a very simplified method, so don't crucify me just because it's very simple, but I'm going to show you that over time it can help all of us position ourselves correctly. So what happens here is on the weekly charts, you're looking at the 13-week moving average crossing below or above the 34-week moving average. And the reason why I like these two numbers is because both of them are Fibonacci numbers. So I like the fact that they capture some nature sequence or some natural rhythm in the universe. So that's why I like those numbers. Now, I have to say this is not my original idea. I found it somewhere and I've used it for so many years. And so kudos to whoever found out this method, but it's very good in helping at least me and most of the people who I know figure out whether they should be looking for markets to go higher or to go lower. So very simple, 13-week moving average crossing above or below the 34-week moving average, and you position yourself in the direction of the crossover. Before I proceed, I want to clarify something. Sometimes you'll notice that the crossover doesn't take very smoothly, so you're going to find maybe in the case of this example a crossover to the upside here that is immediately followed by a crossover to the downside with another crossover higher and another crossover here to the upside. So you find confusing signals sometimes. So what you do whenever there's confusing crossover signals is you find the highest point within the confusing mess, within the moving averages, find the highest point. So in this particular example, the highest point would be here. Draw a straight line, and so the next time the market moving averages cross above that level, so after this confusing crossover signals, so whenever you see a new high after all this mess here, then that tells you the market is favoring the upside. So there are some times when it's confusing. At the same time, it can also happen on the flip side. I've just flipped this chart around, and let's say you get a bearish crossover here, immediately followed by a bullish crossover, bearish, bullish here, bearish here. So you get confusing action. So what you do, you can set an alert, or you can watch, you can set a high here if the moving averages ever move above that, or in this particular case, you can draw a line, which is a red line. The next time the market breaks below that, it's indication that after all this confusing mess here, the market has decided to go down. So whenever you have confusing signals, wait for the moving averages to make fresh highs or fresh lows. So let's go to the Dow, and we're going to begin with the Dow weekly chart going back to between 84 and 87, and you can see that we had a crossover coming into 85, and the market moved from Dow 1500 all the way to 2200. That's a very, very big move for our market. Let's fast forward 3 years later, and you see now the market, and I have to talk about this, as sometimes the moving averages don't give you a very definite crossover. But for example, there was a crossover to go long here. That was again another crossover to go short. But this crossover to go short was not very well defined, and you can see eventually there was a crossover here to go higher. So the 13-week moving average moving above the 34-week moving average here eventually took over. And the one way you can use this is you see that the 10-week moving average, the 13-week moving averages, they break out. So once these moving averages break out here, then the conclusion is that the crossover to the upside is more definitive, and so you should play the market long. And so you see that the market eventually had a nice run here. Fast forward 3 years later, And you can see now coming into this period of 91, there was a crossover there. There was an attempt here to cross and have a bearish signal, but it never happened. So the market continued pushing higher. So the market crossover signals was telling you to continue playing long the market. There was a confusing period here in late 92, but you can see that this crossover took place, but really was not well defined, and eventually the market recaptured with another bullish crossover to the upside. So this is late 92, somewhere in that time frame. Fast forward 3 years later, you can see after that confusing mess here, the moving averages made a new high. So that's how you know which direction. Whenever you find confusing crossover signals, wait for the markets to give you a fresh high. And you can see here the 10-week moving average, the 13-week moving average make a new high. And so you know the market is poised, or at least positioning itself to move higher. And that was a good signal with a nice move here. There was another crossover bearish attempt here that failed. So this was another market buy signal here as the moving averages cross over and separate. So that's a very well-defined crossover. And you can see the market had a nice run from about 3,800 all the way to as high as 3,400 on the Dow. 3 years later, fast forward, and you can see the market would continue pushing higher into 98 here. Now there was a bearish crossover here, so that was enough to scare anybody to go short. And so if you stayed short here, the market would have told you that that wasn't a good idea because there was another crossover here. So here you go short, the market tells you maybe we want to go higher, so buy signal here coming into late 98. And you can see that the market would actually, as far as the Dow was concerned, here move higher, and then there was a crossover here, but this was very messy. I have to say this was not a good signal here. Crossover here slightly, bullish signal, the market went up slightly, bearish signal there, no clear definition here, bearish signal, so the market is down, but the market really doesn't go down, it stays in this general area. And then there's a new low here that the market breaks down here. You can see the moving averages make a new low here, so that's a sell signal. No wonder we had a drop here. There's another bullish crossover here. That bullish crossover took the market a couple points higher, and then there was a bearish crossover here coming into 01. So that was a sell signal there, and the market went lower. You had this major drop here. That this came after this crossover already taken place. So you should have known, if we use our method here, that the market was going to be on a downward slope, and so that drop should not have found anybody that surprised because the market had given us that sell signal. And now I'm not saying it's easy, but I'm just saying that this method does help you avoid big drops in the market after the market has given you a bearish signal. So you see, coming into beginning of 2000, mid 2003, there was a bullish crossover here, so you go long and stay long until you get a bearish crossover. There was a bearish crossover here, immediately followed by a bullish crossover there. So that's confusing. So what you do is wait for the market to make new highs, and you can see that the moving averages would make new highs here. So you go along the market because now you have a crossover to the upside and the moving average is moving higher. So that helps you at least know the market wants to go higher. Let's fast forward 3 years later, and you can see that the market is on a tear here coming into late 07. And then coming into the beginning of 2008, there was a bearish crossover here. So that tells you you're in a bear market. You gotta be careful. Fast forward 3 years later, coming into about June, July of 2009, there was a bullish crossover. So the market was saying time to go back in the long side. And you can see here there was a short blip where it was bearish and then bullish crossover and then bullish crossover. But what you do is, again, you set a high here, somewhere around here. Once the moving averages move above that, then you know that this market is favoring the upside. So you go long with the moving average here in September of 2010. And as you can see, as of right now, in the current market, we've never seen, or we haven't seen any sell signal as far as the moving averages are concerned. So you have to default to assuming the market is still in a bull trend until otherwise. The most recent crossover to the upside was here, which was late 2011, and since then the market has been on an upward slope. Now the one thing I'm going to say is that this does not help you time the high to the very last penny, but it just tells you when things are changing. Just for example, this crossover was not the ideal entry point. The ideal entry point was somewhere here, but it just tells you that you need to position yourself to the upside. So it's just a method I'm sharing with you guys. It's not the best, but it just helps you understand where you should position yourself, long or short. Eric Moade, good luck, peace, and blessings.